Working man investor. Today's video, large number of foreign investors skittish about investing in America. So this is an article with Rebecca Peterson. She served as the chief investment strategy for Bridgewater. I'm going to read you this article and I'm going to relate it to the Cantillon effect, which is one of the economic laws that I study and talk about here on this channel. And this article gives some credit to what I've been talking about, other countries and wealthy foreign investors starting to deleverage a little bit in the United States, meaning looking for other areas to place their money and their investments besides within the United States. And this article cuts down why it could be a problem. This article is really short, and then I'm going to break it down a little bit further. Global investors are undergoing a structural rethink of their exposure to U.S. markets. Again, this is according to economic expert Rebecca Peterson. They're gradually reducing exposure to U.S. assets, and the impact could be significant. Rebecca's prediction comes after having conversations with participants in last week's World Bank and International Monetary Fund meeting in Washington. She said that there are a large number of foreign investors who are worried not only about tariffs, but just about America's reliability as a partner. That's a concern right there because our dollar is not backed by any commodity. It's not backed by gold or anything. It's strictly built off of trust and our reliability as an investment partner and as a country, as a stable government and a strong military force. That's pretty much what our currency is backed off of, that, and we're the strongest economy in the world. She then goes on to say, foreign investors and policymakers are losing faith in the U.S. on broader fears about potential weaponizing of capital markets to achieve their economic goals. Foreigners held more than $31 trillion of U.S. assets as of last June. That's according to the U.S. Treasury. They're looking at huge U.S. allocations that has built over the last several years, and they're saying maybe we should trim a little bit off the top. So basically have a risk premium on United States assets because of the uncertainty within our economy and our government at this time. So what she goes on to say is that just pretend that you're a chief investment officer of a major overseas pension or sovereign wealth fund. I'm going to define a sovereign wealth fund really quick just so you know what that is. A sovereign wealth fund is a government-owned investment fund that invests in financial assets like stocks, bonds, real estate, precious metals, private equity funds, or hedge fund. They invest globally and with the excess money that they get from exporting. So basically they're manufacturing stuff and they're selling it mainly to us. We're the biggest consumer in the world. They're taking that money and then they invest it through a sovereign wealth fund that is managed by their country. And usually what they'll do with that money is they'll use it for the people. So they'll build highways, service roads, things like that. So she says, again, pretend you're one of those people and you're looking at what's going on within our economy, with the tariffs, with our national deficit, and you're thinking to yourself, I'm going to take 2% off of investing in U.S. stocks, 2% off of bonds. That's a 4% shift. Now, that doesn't sound like a lot. However, that's $1.2 trillion leaving the United States. So if you multiply that by multiple countries, it's going to have an impact on us. It'll bring the markets down, and the big concern for me is the demand for our United States treasuries. At this time, 30% of our treasuries, or $7.2 trillion, are bought by foreigners. That's important to understand because our deficit is funded by the sale of U.S. treasuries. And if you have a lot of people bidding on them at auction, versus the price of the treasury up and the interest rate or the yield down. If you don't have a lot of people bidding on it, you got to attract bidders. So what do? You lower the price and you up the yield, the interest rate. So when the interest rate goes up, financing our deficit, we are $36 trillion in debt. And as of this year, we have $9 trillion that have to be refinanced through treasuries. If that interest rate has to spike because these countries and wealthy investors aren't as interested in our treasuries as before, it's going to make our debt service of financing our deficit much more expensive and much more of a strain on us economically, which could also cause inflation. So she then goes on to say that these investment committees will take months. If a sovereign wealth funds, you've got appointed people and it takes a long time. So this isn't going to be immediate. She says that they're just going to have meetings. They're going to have to approve, number one, allocating some money out of the United States and then deciding where to put it. And whether they're going to put it at home or put it abroad. At the time of this video, you're starting to see actually, obviously, gold. Pretty much everybody notices gold has been spiking. And also the German bonds have been going up as Germany is viewed upon as a very stable country in Europe at this time. So again, she just reiterates this is going to take a while, but it is definitely something to be concerned about. So why does this matter to us? Obviously, the stock market goes up and down, but why else does it matter? Like I said, it goes back to our economic laws and the economic law that I studied in the Cantillon effect in part 2 of chapter 6 from Richard Cantillon's essay. You can download this for free at the Mises Institution if you're interested and you want to study part 2, chapters 6, 7, and 8. So in chapter 6, Richard Cantillon, he was in the 1700s. He lived in the 1700s and he studied economics. And he noticed that states and nations would get a windfall of money through 2 ways. One, producing, manufacturing, and exporting. So you're making something that another country wants and you're selling it to them. You're bringing in that new money into your economy. Everybody begins to get more wealthy. The United States doesn't have that option anymore. Pretty much all of our manufacturing has gone overseas as time has gone on and our standard of living has risen. Our wages are a lot. We need a good wage to live in this country. Because of that, we're not able to compete with the Vietnams and the Malaysias and the Chinas and the Mexicos of the world that can work for, in some of those areas, $10 a day. We can't do that here. It's a major reason why our manufacturing jobs have left. Now, Richard Cantillon also noticed the other way that countries and nations got a windfall of money is through the discovery of a gold or silver mine. So when the miners went out and started pulling out that gold or silver, has always been viewed as money to mankind. They prospered. Everybody prospered up until the point that the mine ran dry. And then they had no more manufacturing and their mine had ran dry. They had no more new money coming into the system. So everybody fell into misery and poverty. The United States, gold mines, it doesn't work like that. Not in today's day and age. Discovery of a gold mine doesn't give our country a windfall. The way we bring new money into the system is strictly by selling our debt through the sales of treasuries. We are the largest debtor nation in the history of the world, but we're also the only debtor nation in the history of the world that has the luxury to borrow in their own money, their own currency. So what do I mean by that? Basically, we're the reserve currency of the world. We need to get the dollar out to other countries so what do we do? We import. We pay in dollars. These other countries take these dollars and then they turn around and they're buying our U.S. treasuries, our debt, and we're paying them an interest. So we're giving them money and they're loaning it right back to us. That's similar to a gold mine. That's how new money continues to come into our system. When we take this money and we do our infrastructure, we do all of our social programs, our welfare programs, all financed off of debt, off of the sale of U.S. treasuries. It's important that other countries continue to buy our debt simply because, as I explained earlier, that demand keeps the interest rates low. It's the same as mortgaging a house. If you want your payment to be less and you need your payment to be less, you don't take out a 15-year loan, you take out a 30-year mortgage and spread it out over 15 more years. Same with our debt. We want the interest rates to be low, and the only way for the interest rates to be low is for there to be huge demand in the treasury markets for our bond. If we get to the point where enough countries enough foreign investors and enough countries stop buying our treasuries, and the interest rate on the 10-year note, which is currently about 4.2 last I looked, if it gets up to 5.5, it's going to really hurt us. It's going to hurt how we finance and service our debt. It's going to hurt our economy, and it's going to cause inflation. So that is what she's talking about. Not only can the stock market go down because you're having less people buying, stocks move off of supply and demand. You have countries and foreign investors stop buying within our capital markets. It's also the treasuries, because what they're looking at cutting, 20% equity market is $18.5 trillion. 30% of U.S. treasuries, $7.2 trillion. Again, $7.2 trillion less coming a year to auction to buy our U.S. treasuries are going to could enforce the interest rate to go higher, which causes our debt service to go higher. That's the point I really want you to get out of that. It's something to watch. It's not something to panic about yet. I wouldn't mortgage my house and go out and buy gold if I were you. But if you do have a large portfolio and you do have some money and some wealth to protect, it might be a good time to have 3 to 5% of your portfolio in gold or silver. You can do that in the stock market by buying a gold ETF. You could buy a gold mining company, or you can go to coin shops and buy physical gold and silver coins. It's not a bad idea. And just watch the 10-year Treasury notes. You don't have to check it every day like I do. You can check it once or twice a week and just keep it in your mind. Is it going up or down? Because it's critical this year. Like I said, 36 trillion in debt, 9 trillion have to be refinanced. So we really would like to finance that no higher than 4.5% over 10, 20 years. You don't want to get into the fives because it's going to hurt the economy. So that's what I got for you today. Working man investor. Keep grinding, people.